Welcome everyone to the webinar. Today we're discussing the growth of sports betting on the prediction market platforms, and in particular the trading of sports parlays or multis, and how that's grown over the World Cup period recently and will continue to grow into the NFL season. I'm joined today by Bernard Marantelli, founder of White Swan Data. Bernard has spent more than 20 years in professional betting, finding edges in various parts of the global gambling ecosystem, from sports betting to lotteries and many other things. Welcome, Bernard.
Michael, thanks very much for having me.
Before we jump into things, just got to read a brief disclaimer. The webinar is general information only. It's not financial advice. While we may talk about some betting strategies today, it's certainly not an invitation to bet on anything or invest in anything. We'll speak for about 20-30 minutes before opening up the discussion to audience questions. There's a little chat box in the bottom right-hand corner of your screen. You can send us a question at any point. I might try and slot them in through the discussion. Otherwise, we'll save them all for the end. Only your first name will be shown when you ask a question. So Bernard, you've done a lot of interesting things through your career. Many are covered online in various podcasts and articles. So I won't rehash too many of the sort of historical things. I want to focus on the current opportunities you're working on. Can you sort of set the scene for us in this market making and prediction markets space? You know, what are the prediction market platforms, first of all, and how have they managed to grow so big and so quickly?
Well, I think, the scene is that we're looking at effectively what's an exchange, very similar to a financial exchange, very similar to Betfair. And it's kind of quite interesting that, I'm back where my absolute daily focus is on prediction markets. And that was 2004 and 5 for me with Betfair, building out automated market making, trading algorithms, etc. So, and Betfair, let's say, broadly failed, although they grew into Flutter, they failed as an exchange, and we can go into reasons why that might have happened. But it's basically a reincarnation of those to some extent, with slightly different wrappers and slightly different regulatory paradigms, and a different time in society as well. So at their core, they are an exchange where you can change an opinion on anything. You can or trade or bet on an underlying question. Will Donald Trump be president? Will so-and-so win the Emmy? Will the Patriots win the football this Saturday? So effectively, for the listeners that are aware of Betfair in the past, very similar to that in their actual back-end mechanic and what they actually do. Presented a little bit differently in that they're called prediction markets rather than an exchange. Presented differently to the extent that you generally trade the percentage of the outcome to happen, which is a UX that could be important in their rise. But you're essentially looking at a similar product in a new time frame, in a new package. They're predominantly succeeding in crypto world and the USA. And the listeners are probably not fully aware, but the USA is a very complicated patchwork of regulations and fights between state and federal regulators as to who controls what. And the prediction markets within that space have managed to allow sports events contracts, as they might want to call them, to occur in some states where sports betting is not allowed, predominantly California and Texas. And that's given them a big foothold. And then publicity, growth, interest, excellent UX, excellent customer acquisition, topical markets, and that's allowed them to grow significantly over the last 2 or 3 years.
And so it's a betting exchange, essentially. So that means there's people on either side. They've obviously done a great job of getting a flood of retail punters on there. Can you maybe explain why or how they've been able to do that? And then you sort of explain who's on the other side taking their bets.
Yeah, so look, I'm not the marketing expert, and I understand they spend significant sums, but I think they originally got footholds around some political voting, mayoral elections in New York, where most of the exchanges are. And there wasn't a lot of places to do that in a reliable manner. So I think they got footholds there, then they got into sporting contracts, and obviously the World Cup was, just unbelievable growth for firms like Kalshi, Polymarket, ProfitX, Novig. where they were going 3, 4, 5, 6 times client numbers, not volumes, actual client numbers in that period of time.
Yeah, right. And so who's on the other side of all these retail punters?
Well, that's the distinction, let's say, between a sports book and a prediction market. On a sports book, the house is almost exclusively the equity holders of the company. They are the house versus the retail people they recruit. In a prediction market, and there's some subtleties around agreements and arm's length companies and stuff, but in real terms, the prediction market has to be the exchange, and they can't be a counterparty to the bet. So generally, retail come in and bet, and market makers provide some sort of service or liquidity there. And there's broadly 2 types of bets that are occurring. And those bets are a single: will Carlton beat Collingwood on the weekend? Yes, no. Carlton trading at 64%. I might be disconnected, but I'm a Carlton fan, so Carlton trading at 64%. And you're buying and selling 63, 64%. And retail could take either side. Retail might even buy at 63, sell back in 5 minutes at 67. So in that sense, the distinction between house and backer and retail and professional becomes a bit more blurred. When you get to the other main element of a sports book, which is a parlay or a multi, as they call them in Australia, or a combo in the US, these are multi-leg bets. Carlton to win, Essendon to win, Bears to win, Western Sydney to win in a 4-fold. And in that environment, there's really no retail layer to take that risk. That 4-fold multi might be 10 to 1. And you say, boom, 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 it updates, 10 to 1. Do you want it? And that 10 to 1 is presented by one of the market makers. In the back end, the request comes in. Kelshi or ProfitX send that request to their market makers. All the market makers fire back their answers. The exchange presents the best answer in the UX, or the highest answer, or the highest price, and the retail person can take that or walk away.
Yeah, sure. And these are the parlays in particular. They're obviously a sort of prized product for the US sports books. I think it's circa maybe 25% of their turnover is parlays, but it's a significantly more or a significantly larger share of their margin because the parlays are actually higher margin products. What's different for a parlay offered by a sports book versus a market maker? Are they in terms of the margin and any sort of other characteristics?
Yeah, so they are about, if you look at the American Gambling Association data of the various states, they're in the mid-30s in terms of turnover, but they're in the mid-50s, approaching 60 sometimes of P&L, or of GGR. And that's because they're a higher margin product. The margin generally comes out of 2 things. The number of legs you add, because each leg they're multiplying up with some sort of margin, and generally the price. If the price is larger, the retail person becomes less price sensitive. If the price is larger, the house or the market maker probably wants a larger margin to reduce his own volatility slightly. And you package those things together, and you tend to get an escalation in margin as you get an escalation in price and an escalation in number of legs that you package together. There's not a lot of other difference really until you get into sort of technical structure of the exchange. In the exchange technically has a minimum price of a contract of 0.001 cents, which means you can't offer a price. If you've got 0.001 cents, you can't offer a price bigger than 1,000 to 1. A lot of parlays on DraftKings, FanDuel, Bet365 go through at a much bigger price than that. Retail people looking for that lottery type ticket, parlaying up 10 or 12 games at 40,000 to 1 for a tenner, and looking to get 400K and change their life. So there's not much difference if you look at the 2 to 1 to 20 to 1 range, but there are other components that make the sportsbook parlay have a longer duration, a longer price than the exchange parlay or the prediction market parlay.
What share of the parlays do you think are those lottery tickets versus the rest of them? Like how much of the market is sort of cut off from the market makers on prediction markets versus the sports books?
Well, firstly, let's discuss why it's cut off. It's only cut off for two reasons. It's cut off for the minimum cent increment in the contract size. So if you want to allow a contract to trade 0.000001 cents, then whatever that is, 10 million to one. So someone could have a 10 million to one parlay. The second thing is that when that 10 million to one parlay transacts, somebody, a market maker, has to supply $10 million of capital. Because they're an exchange contract, they need to be fully collateralized before the transaction occurs. So those are the a technical reason why it's cut off, the contract size, and a collateral reason why it's cut off currently. There could be examples in the future where they net the contracts and allow those to be offset. At the moment, when someone wants $1 million to one on a parlay on DraftKings or Bet365, understandably, and I'm not suggesting they can't, but nobody stops to ask, do they have the capital to pay that parlay? It's based on balance sheet. Everyone assumes they've got enough balance sheet, that they've got pretty good risk management, and it's not going to happen. Having said that, there's a lot of volatility in pricing, and more so in the results. And in Q4 2025, both DraftKings and FanDuel issued profit warnings around the 500 million mark, and that specifically came from adverse NFL results in the beginning of last season.
And so White Swan, your company, has been market making on Kalshi and other platforms for some time now. What do you need to do as a market maker to do it well? What do you need to have?
Well, so just to be clear, if you look at the prediction markets, they've been growing or in their infancy since about 2017-18, and they became, let's say, substantial around late 2024, early 2025. That's for singles. The RFQs, which is request for quote, which is the parlay or the multi or whatever, I think they only entered the market around last September and really only started to get out of sort of, full beta and much more widespread use in sort of January of this year. And then obviously, as we mentioned earlier, completely exploded during the World Cup. We market make some of the singles and underlyings. These are complex places with lots of traction and lots of people doing it. And to be perfectly clear, less margin, more sharks, more problematic technology requirements and problems. The RFQs, they are more complicated on one level because they're parlays. A lot of the risk is correlated. A lot of the risk could be negatively correlated. Your liabilities can accelerate rapidly if you don't have good risk management. So we focus on the RFQs because, the parlays, we focus on the parlays because they've got a higher margin and a higher complexity. And we think we've got a greater edge the more complex something is.
And what contributes to that edge?
Well, in a world where there's no market makers and there's an avalanche of retail, I think some elements are less important. Edge becomes, in some senses, then technology, because really you just need to be live because you're going to take a fat margin if you're live and you're on the screen. I think as margins compress, or smart people enter that market, you need fundamental pricing. So not just good technology, but making incremental gains over the other market makers by better pricing. So they might be making 12% on turnover. You might be making 13%. That allows you to grow your market share, compete, handle more volatility. There's lots of reasons why incremental basis points between you and the market is super advantageous, particularly as margins go down. And then, of course, you need capital, and you need immense capital because you have to collateralize everything. And let me really explain that how extreme that requirement is. If someone comes in and says, and imagine football, head-to-head football, point spread football is really a coin. So if someone comes in and says, on the next 3 football matches, I want home, home, home. And I say, great, fair value 7-1. I'll give you 7 million to $1 million. And then someone comes in and says, I want home, home, away. And I offer them 7 million to $1 million as well. I have to put up $14 million of capital, despite the fact that I can only lose 6 million between those 2 transactions. Add a third transaction in there, which is home, away, home. Again, completely mutually exclusive. I'm now at 21 million of capital, and I can only lose, in a worst case scenario, 5 million. So the capital requirement becomes a major moat for people with capital requirement. So there's lots of things you need, but I break it into 3 pillars. You need significant capital, you need outstanding tech, and you need very good underlying fundamental, particularly correlated pricing.
It seems to me like someone who's a little bit on the outside of this part of the industry, it's sort of opaque who's in there competing. And do you have a sense of like how many firms are out there with those pillars that can do these things properly, like White Swan?
I mean, I have some senses because you see the participators in the market. And when you're having dialogue with prediction markets about coming on as a market maker, there's indications of how many people they have, etc. I think you're talking in a lot of places in the region of 20 to 80 doing an RFQ quote on a smaller exchange to a large exchange. And then obviously there's a massive range in there between very big firms through to, you know, as they call sort of garage bands and a couple kids sitting at home, and they might have some good pricing and they might have used a bit of Claude coding and vibe coded something up and they're trading $500,000. And look, some of them will go broke and some of them will grow and become successful. And they will, a lot of that delta between success and failure, some of that will be volatility and risk management for sure. And some of it will be pricing and technology.
Yeah, and just on the tech, how quickly do the platforms require market makers to respond with a quote? And is there the ability to get significant edge there, or is that more of a table stakes thing?
There's ability to get some sort of edge, because if you think about the UX that you would do on a sports book in Australia, where you click Carlton, Collingwood, Essendon, as you click Carlton, Collingwood, it starts to tell you 3.1. As you add Essendon, it tells you 6.1. Now, it generally doesn't change. It might change if the underlying sports book changed the price. What happens on most of the prediction markets, as you click Carlton, Collingwood, and you add Essendon, it says 6 or maybe 6.2, but that was the best offer they had. And then another market maker that might have been slightly slower from a technology perspective adds 6.3, and your price bumps up. And then someone who's another, and then you transact at 6.3 because you were happy. But if you left that UX open, it might go 6.3, 6.4, 6.3, 6.2, and jump around a little bit as market makers either change their offer or cancel their offer or time their offer out and those sorts of things. The general process is seconds, not milliseconds, as a trading would occur on a single underlying. If you're just trading Carlton, Collingwood, milliseconds completely matter. If you're trading an RFQ, I mean, it's still milliseconds, but you're talking about 500, 800. You're talking about half a second, 1 second, even 2 seconds that don't really impact your ability to be competitive.
Yeah, sure. Okay. And so you've been doing the RFQ market making for, you said since sort of Feb is when you really ramped it up?
Yeah, well, Feb we got into it, and look, you know, the technology build, even for people like us that have already got parlay pricing, already got outbound pricing, already got risk management engines and people and staff. The technology build was not instantaneous. You've got to go and get the APIs. I think we're live on 7 RFQ platforms now. You've got to go and get the APIs, the technology. You've got to understand the feeds, the answers, the market mapping, the under overs. And some of the markets refer to over or under no yes, which really means over. So, there's some mistakes to be made there. And you've got to realize that the supplier of that technology, the exchange, they're building out at the same time. They're in a market share race to be live with new products. So things are coming out that are, advanced beta, to be perfectly frank, in some of the exchanges. So you're working with, growing technology on both sides. So yes, we were, I think, first live on the RFQs around February, singles last August or September, something like that.
What have you found the most challenging aspects of scaling that strategy?
I think it's just the amount of things you have to do at once. Our tech team is excellent. We've built to, as I said, 7 platforms in, the last 4 months. We have a time span of new platforms getting on our technology in less than 2 weeks. Just the scale, the growth, the amount of data that's produced. How do you digest that data, use that data? How do you suck everyone in your business into this part of the business? Your typical scaling challenges. Where do you repurpose from people from in other parts of the business? It's very hard. You want to go out and hire someone new to help you scale here. They're on a 3-month or 6-month non-compete. They won't join you till next year. So some of the manpower, a lot of the manpower has to come internally, particularly at the skilled level. That creates challenges or some challenges in other parts of your business. The technology has to work 24/7. There's one thing with prediction markets. If DraftKings accidentally offer you 20-1 on a parlay that should be 2-1, they're likely, and not just DraftKings, 365, everybody, they're likely to what they call palpable error that bet and say that the price was so wrong, it couldn't have been believable. Therefore, it's going to be void. You don't have that protection on an exchange. It's a financial contract. If you write that contract wrong, you pay that contract. And we did that one day early on. There's some confusion still about where it originated, but an overs market was mapped to an unders market. And you're giving 4-1 on an over, on an alternative over that should have been 1-4. And of course, you write the contract. They got the overs. The result came the same way, and we dusted off 100K or something like that. It happens. And I think that's one element that means your technology has to be incredibly good, because there's no fat finger trades, unwinds. You ride it, you're dead.
Yeah, sure. We've got a question in from David, who is asking, do you have visibility of the market that's being dynamically created by an RFP? For example, the prices liability offered by other market makers?
No,
or is
broadly, no.
Just your own? Yeah.
You have some visibility about where they had transacted, but let's say a retail person comes in and asks for $10 on a treble, and then 40 seconds later someone asks for $100 on a treble. You might be able to assume that's the same person increasing his stake, but it might be a new entrant. You don't know. You know that you're unsuccessful, but you don't really know that if you're unsuccessful by a penny or a lot. And you don't know, a lot of the times you don't really know that in live to be able to sort of escalate your bid. Now, some of that information becomes available after the trade, so you can be a bit more alert for the next time around. But no, in real terms, it's not, the RFQ is not like a visible, clean order book that you see on an exchange where you see 62, 63, and you see how much money is in each price bucket. Now, let's be clear. If you look at a single and you see 62, 63 with 1,000 here and 500 there, that is a millisecond snapshot that they publish to you. And even if they're updating that every 30 milliseconds, there's 40 transactions going through in that time. So those things are really snapshot. Now, your API call, if you're using an API call, if you're using third-party trading software, etc., that has the snapshot full visibility. But again, those snapshots are literally updating so quickly that they really are that. They are a representation of what was there at that time. So, you have to trade that very quickly, and you have to infer some of that information, and some of that information you get after the trade, which may allow you to consider your price for that trade later. The same as a single. A single can be 62, 63, and you say, I'm a backer at 62. And as you send your order to the market, you get matched at 64, because between your visualization of 62 and your bet that you send into the market, someone moved the market up to 64 cents. Obviously, we know the price priority there. The person coming into the market takes out the order book. But these things are, ultra fast.
Understood. We've got another question in from Sean, which is another one sort of around the mechanics of this RFQ process. Sean asks, do you request quotes in the hope that other market makers get it wrong, or do you just concentrate on the lay side of the bet?
I think a lot of people will request quotes. I think you've got to contemplate what's the value in doing that versus the value in growing out your tech stack, integrating more markets, more people, more exchanges, better pricing, better ecosystem knowledge. Because I would say that anyone who gets it wrong, like properly wrong, is going to fix it quickly or go broke quickly. So I think that opportunity is more limited than focusing on the other side of the business.
Yeah, that makes sense. Going back to these capital requirements, because it's obviously sort of a big deal where you need to collateralize all of your liabilities. The CFTC, who regulates these platforms, do you think they will look to change those strict collateral requirements, or is that sort of how it's going to look for the foreseeable future?
I think it's definitely going to look that way for a year or so. It's not ultra easy to do, to net off. You've got to remember there could be 3,000 markets on an exchange on a Saturday that you could parlay any of those 3,000. Well, that's, and most of them are head-to-head markets, but that's technically 2 to the 300 probability trees, massive space, ridiculous space. Now, of course, they're not all going to be used. No one's going to take a 3,000 leg parlay, but there's 5, 10, 15, 20 leg parlays, and they're all independent from each other, as in retail selection is independent. So you end up with a gigantic spider web of risk that you've got to digest down to understand your own personal risk. But then you've got to digest down if you wanted to even imagine netting those from a capital requirement perspective. So I don't think that's going to be solved quickly. I don't think there's probably enough upside for a regulator or an exchange to solve them, because if something went wrong with the netting process, who's left holding the baby? Bill and Ted from a garage band, let's say they net wrongly and these guys write off, tens or hundreds of millions of dollars of liability that they don't have. Who's carrying that baby? So I think it'll be slow and cautious about getting around that. And I think there's participants in the market that have capital that won't even want that done. So, because that's a moat for them. So I don't I'm not in the dialogue of the exchanges and the CFTC, but I'd be extremely surprised if it happened this year.
Yeah, sure. And that sort of leads to the next question I had, which was around these big hedge funds, which I'm guessing is sort of the people who may have a vested interest in keeping those capital requirements high. What's to stop them coming in and pricing out players from the traditional sort of wagering world like White Swan? They seem to have, significant capability. Are they going to get there?
I think if you look at, a big hedge fund, and we know some of them are there, and we know some of them are definitely entering, and we know some of them are looking around buying syndicates out for their technology and their pricing technology. I think in the big hedge fund, you have infinite capital or broadly infinite capital, very good tech for trading single markets because they're already market makers on crypto or financial exchanges, diminished tech or developing tech for the RFQ market. They've never really been involved in pricing correlation of sports bets, and they've never really been involved in avoiding sharps in sports betting. They might be avoiding sharps or informed traders in the stock market, and then they don't have fundamental pricing. So, if you look at the three pillars, they're 11 out of 10 for capital. They're maybe 8 out of 10 for RFQ pricing and growing quickly, and they might be 3 out of 10 for pricing, which might not be essential now, but is going to become essential in time. So they're probably going to have to buy or grow that third pillar, and growing it will be slow. It's a couple of year process to really get, even with money, to get somewhere where White Swan Data is. So then you say, well, hang on, do I want to grow that over 2 or 3 years or go and buy it and provide the capital? And then I think if you look at someone like White Swan Data, where let's say 9 out of 10 on pricing, where 9 out of 10 on RFQ technology, and where 4 out of 10 on the capital that these people have. So those two things, we've got to improve the capital end. They've got to improve the pricing and technology end.
Yeah, sure. Some of these market makers are affiliated with the exchanges. Have you seen any advantages afforded to them?
If there were advantages afforded to them, I probably wouldn't know what they were. I think it occurs, and it's the regulator's role to make sure that everyone has free and open access. And yeah, look, it is happening. A number of them have their own in-house market. When I say in-house, heavily affiliated companies market making. It may well be that at some stage the regulator says, hey, Exchange 27, your in-house market maker is only allowed to market make every other exchange, not your own. So they will still have business opportunities for these individuals and these groups of their business. And when I say their business, they're generally packaged a bit further away from their business. But if you look at the traditional sports books, they've got in-house risk teams that have run the parlays for the last 10 years or last 8 years since PASPA. Now they open a prediction market to get access to the states that they can't have in their OSB, or they want the hubris of everyone saying, oh, I've got to get on a prediction market rather than a parlay. And to the retail press, and there's not really a difference, let's be clear. So yeah, I think they're kind of giving away some of their customer value by wanting the presence and competing in a prediction market space. But maybe these companies end up running prediction markets in states where there's no sports book, and sports book where there is sports book. So, and they end up with these super apps that are sweepstakes in some places, casinos where it's allowed, sports books where it's allowed, prediction markets where it's allowed, but they still get some sort of coverage in almost all 50 states.
Yeah, sure. We've got a question from Oscar, who's asking about the World Cup. During the World Cup in peak periods, how many requests were you receiving? Was most of it pre-game or in play? And what patterns did you see in teams, players, and outcomes that the punters wanted to back?
So most of the parlay count and handle and risk is pre-off. The teams they wanted to back was everybody who won, and the players they wanted to back was everyone who scored. I would say the two major markets through the World Cup were the superstars to score: Haaland, Messi, Ronaldo, Kane, Mbappe. They were just avalanches of money for them to score every game. Avalanches of money for those teams to progress, and avalanches of money for that key double. I would say that would be the singular biggest key double through the World Cup: superstar player followed by his team to win or progress when we move to the progression part of the market.
Yeah, sure. And obviously a lot of those sorts of bets got up during the tournament. How did White Swan fare over the sort of length of the World Cup?
Length of the World Cup was good, but there was one day where game one, Mbappe scored, France won. Game two, Haaland scored, Norway won. Game three, Messi scored, Argentina won. And game four, Mexico's leading scorer scored and Mexico won. They were the 4 games one night. And I think the market did about 20% of its balance sheet, like the global market doing RFQs that day. 20%, yeah. Probably mid-teens of their balance sheet that day.
Yeah, significant. And looking ahead to the NFL, which is obviously the next major period for the RFQs, what does the NFL opportunity differ? How does it differ from the World Cup?
I think it's going to be several-fold bigger again. It's very hard to imagine that $700-900 million of liability in RFQs daily on Kelce in the World Cup, where Americans don't really bet soccer, or until now have not bet soccer, won't translate to $4, $5, $6 billion of RFQ volume risk liability during an NFL Sunday. So I think the volume is going to be 4 or 5x again. But the NFL is unique in that there's only about 17 regular weeks of about 17 games. So it's widely known as the most volatile product in an American sportsbook ecosystem. If you look at NBA, I think there's about 1,400 games a year, and it's sort of 3 or 4 or 4 or 5 most nights, 5 or 6 nights a week. I'm not expert on the schedule, whereas NFL is 16 games on a Sunday, 1 on Thursday, 1 on Monday. So you're spiking your volatility into a low number of games. You're spiking your volatility into a single day, which means that's spiking your capital requirement significantly. So those are the unique elements of the NFL. They're all condensed on a Sunday. It is the biggest betting medium per game in the US by several fold, and it's all on the same day.
Yeah, right. And does that sort of have an implication for the amount of profit you can make, given that there's sort of fewer game days? Because you sort of lock your capital up on a day basis rather than a game basis if they're all at the same time, right?
Yeah, so if you look at something like Wimbledon, no one's trading Thursday's tennis on Tuesday because they don't even know who's playing yet. So Wimbledon, you trade today, and almost no one is taking a parlay from today into tomorrow. They're taking parlays today, and then they're taking parlays tomorrow. That's not going to really happen in the NFL. So again, you might start laying parlays on Wednesday, Thursday, Friday, but they're not going to resolve until Sunday. So in one sense, your capital requirement for the Sunday is going to spike, and that's going to be your maximum capital requirement for the whole year. NFL Sunday is your maximum requirement you will ever have on a daily basis, which is a quasi-weekly basis because you grow into it. But you will be able to do the college basketball, the college football, the NFL, the EPL on a Saturday as well, because they're all going to be running concurrently. So you'll have pretty good and consistent sort of volumes during the week that possibly grow and spike if the Americans keep betting soccer, European soccer, which they might not, but grow into college football, which I think is on a Friday night, and then grow into Saturday NFL, which will be gigantic, and then settle down again on Monday through a bit of UEFA and NBA. And when I say a bit of NBA is going to be hundreds of millions of dollars of liability, but it's not going to be, it might not be billions of liability. So you will have this weekly process of maybe 1.5 to 2 billion or $1 billion a night during the week and 6 billion on a Sunday.
And of that sort of 6 billion, how much does White Swan want to have of the market?
I think in a world where you want to beat the market, you can't be 80% of the market and beat the market because you are the market. So we're probably looking to be 10-ish% of the market. And I think at 10-ish% of the market, and there's going to be a couple people that might be 20 and 30% of the market, but obviously there can't be many people at 20 and 30% of the market. But I think, and look, numbers are going like this, market makers are growing, regulations are changing, clients are coming in, capital requirements may or may not change. So there is an absolute ton of variables that are getting resolved literally on a daily basis at the moment. But that's our current objective, to be there in around that size.
Yeah, understood. I've only got one more question, and then we'll turn to some audience questions. So please, everyone who's listening in, if you have any questions, just put them in the question box there. My last question is the opportunity beyond the NFL season. Obviously, a lot's been sort of spoken about around the NFL season, the opportunity there. Is it still an exciting opportunity for you beyond that or outside of the NFL season?
Yeah, of course.
In terms of market making? Yeah,
the NFL, and again, there's so much variance here that we don't know how this resolves. We're tracking about 125 prediction markets at the moment that are going live in development, etc. And then on top of that, you're going to have the layers, the routing layers, the technology layers, the pricing layers, the trading layers. So there's 1,000 companies probably trying to generate some sort of edge and business in this space. When the NFL finishes, and imagine the NFL is growing and the NBA and the soccer and everything's growing underneath, when the NFL finishes, it definitely falls down, but it's going to fall down to an escalating base as well. We do a lot of risk management for all types of things. We've done risk management for weather, for airports, for snow, for cancelled flights, for promotion and relegation of football teams. We've done risk management for pubs that don't sell beer if England get kicked out of the Euros. So they want a insurance product, for lack of a better word, that if England win the Euros or reach the semi-final or the quarter-final in a tiered structure, they get paid more money, or they pay more money. And if England go out early, what are they doing? They're smoothing their beer sales. Restaurants will hedge Game 7 of the Knicks versus the Spurs, because they've got to go and buy $3,000 of meat and vegetables and all of that to run their restaurant. And their restaurant's going to have 10 people or 1,000 people, depending on whether it's a Knicks night or not. So I think these exchanges are definitely going to be very sports-centric to begin with. But I think they end up being just, we hedge everything. And humans generally don't like volatility, except humans like me. We love volatility. And I think we just, we could be pricing, more weather and footfall traffic and snow and promotions, relegations. I see worlds where you end up trading contract size of football players and soccer players, where you can own 1% of a synthetic, Webembe or whatever his name is, where you can actually own a percentage of him in terms of his asset, his growth, his income, etc. So I think we've not really seen past the, step one of what these exchanges are allowed to trade and normalize as a trading product.
We'll turn to some questions submitted by the audience now. I've got a couple of related questions here around hedging. John is asking, can you exit or manage RFQ positions before settlement? And Theo has asked a similar question. What percentage of parlays do you hedge out?
You can hedge, but your ability to hedge is complicated very much by whether the legs are concurrent or not, which means the NFL is the most unhedgeable parlay because nearly all legs are concurrent. The slates are all overlapping, and the length of the games are long. So yes, if you write a treble, one Tuesday night game into one Wednesday night into one Thursday night game, you could ride it and hedge it out. But most parlays are occurring in some overlapping set of events because people want a parlay that resolves in the next 3 or 4 hours, not the next 3 or 4 days. So you could hedge, but I think the real requirement here is to make sure before you write the risk, you're happy with the risk rather than writing the risk and then going to hedge it somewhere.
Yeah, sure. So it sounds like it's not a big part of your strategy.
Yeah, and look, there's significant transaction fees on hedging as well because, the pricing for makers and takers in an RFQ world, predominantly at the moment, there is no cost for a maker because they need the liquidity. But then if I went and hedged it in a single, I'd become a taker and there would be some fees probably to be negotiated. So I think in real terms, the correct approach is to make sure you don't ride it unless you want it.
Understood. We've got a question from Olivia. Why does a punter choose Kalshi over the traditional sports books like FanDuel? Is Kalshi growing the total pie through accessing markets where sports betting is banned, or is it a better experience such that people are switching?
It's funny, as a professional gambler, I'm not the right person to ask if something is a better experience or not, because my interest in the front end of a UX, I just want to get to the bet that is the wrong price. They're definitely growing the pie two ways. They're growing the pie by going to markets that don't allow sports betting. Now, I would say they're growing the global pie in those markets, and they're certainly cannibalizing probably some of the black market in those markets. So that would be one thing. I think they're growing the pie through access because a lot of the financial platforms, such as Crypto.com, Robinhood, etc., are saying, well, we trade more or less everything except sport. Let's trade sport as well. So that's opening sport to some people who wouldn't maybe be bothered logging out of their Robinhood account and going into a FanDuel or a BetMGM account. Now, these conversations we're having is mostly in an American context for the moment. So yes, I think they're growing the pie in terms of geography and in terms of access to client bases that were not traditionally looking at that space.
We've got a question from Luke. How does White Swan's edge hold up against FanDuel, Flutter, and DraftKings entering as makers with their own decade of proprietary parlay correlation data?
It's very hard to know because we don't really know when we offer 6.2 and somebody trades at 6.3. We don't really know if that's Bill and Ted in their garage or it's FanDuel. So we don't have good visibility on that. What we have is some visibility through published data about what the ROI or margin is for FanDuel and DraftKings on a state-by-state or global basis. And what we have is some information about what our edge is on a prediction market. And of course, the edge for the market maker on the prediction market is generally a few percent lower because the prediction market is adding on a few percent as well. And there will be some form of competition between a person getting $15 for a parlay on BetMGM and $15 for a parlay on Underdog Fantasy or $15 for a parlay on Kalshi. So the market maker will be a little bit cheaper on Kalshi because they're adding a fee than the in-house market maker, let's say on Underdog, or the in-house market maker on, and Underdog just announced they're launching their own prediction market. So that dynamic will change a little bit. So I would say we are their equals for sure, but a little bit hard to understand that fully. They have only sat behind retail traffic for their decade, where we have generally been an outbound predator of those markets for the last decade. So they sit behind a 15% retail edge, let's say as a broad number, and we're generally betting into, this is White Swan Data, the syndicate, we're betting into parlays against a 15% edge. Now, beating a 15% edge is not the same as being the book, but it goes a long way to being reasonably confident that our pricing is extremely strong. And then if we look at our performance in the market so far, it's fairly clear that our performance is very strong.
Where do you think the level of margin in RFQs settle longer term?
I think it's hard to know. We haven't seen a lot of compression in parlay margins in traditional sports books. So I don't think it settles quickly, but the ability for 50, 100 people to market make obviously will create some pressure. I think the exchanges will want some pressure on price because they'll want to migrate clients from a traditional sports book to an exchange through better UX or better pricing or better, super app experience that they can do whatever they want. I think it'll traditionally run a couple percent lower than a sports book for those reasons. If it gets, I don't think there's anyone interested in deploying $10 billion to Kalshi and crushing the parlay market to 2% because they're going to just be sitting on a shit ton of volatility, which doesn't make that a responsible decision, even if you're Berkshire Hathaway or Elon Musk, unless you just want to do it for shits and giggles. So I think it will stay there because the individual actors should be rational and shouldn't want parlays trading at. And when I say parlays, there's a spectrum here. A money line twofold will go through at 2 or 3%. A 15-fold should never be going through at 2 or 3%. But in broad terms, if you chase the margin down to 4 or 5% on a 6-leg parlay, now you get pros entering that market. Whereas at the moment, the margin protects you against not all pros, but some pros coming in there, I think.
Sure. I've got a question from Ben. With college football and the expansion of conferences like the SEC, Big Ten, and games played on Thursday, Friday, Saturday, how does that affect the market? Is that a significant part of the RFQs?
I think I caveated before that I'm not an expert. I got in trouble with Brad Allen the other day for calling the Knicks versus the Spurs the World Series. So I think it's safe to say that I'm not a sporting expert. Look, all of these things will grow. Nothing will replace the NFL in the midterm future of several years. But you will have to, if you've got limited capital, you'll have to say, well, hang on, I've got $4 million. I can't trade NFL until Sunday, because with $4 million, I can do it all on college football, and then I can do it all on European soccer, and then I can do it all on NFL Sunday. So that person with limited capital is going to have to say, hey, I've got a request for a Sunday parlay on Thursday. I'm only going to write that if I get 25% edge, or I'm going to write it on Sunday at a 12% edge. So there's this whole thing of maximizing the ROI of your bankroll in that environment. And that environment is constantly evolving. And that's where you get back to the point of the infinite requirement for data and the amount of data that's available, and literally be able to keep pace to digest all of that data to make better and better decisions. It's a gigantic problem, and the most attentive, diligent people are going to win the game. And I think when you look at a lot of the smaller people, they've got their limits because they're going to have to integrate to 10 people to get that pricing. Well, to get access to the 10 markets. If you're a couple kids at home, integrating to 10 people is going to cost you $300,000. Well, that's 30% ROI on your $1 million bankroll. Now you can Claude and vibe code and all of that and do one or two and have bad reporting and bad data. But bad reporting, bad data, bad code, they're all going to turn into significant disadvantages over time.
What do you think that level is around, like, not only the operational, backing you need, but the bankroll level where you've got enough to be on all the platforms, to be able to lay all the bets that you want to lay, but I guess not be too big that you're, like you said earlier, too big in the market? Like, what sort of bankroll are we talking that is that sweet spot? Is it sort of 50 million? Is it 100 million? Is it 500?
Well, look, if someone said to me, in the NFL, let's say that it gets to $5 billion, and someone said, Bernard, you've got 50 million, I'd have a super nice ROI, because you could be extremely selective about what you were doing. But, you're 1% of the market, and that would be suboptimal in terms of your GGR or whatever term you want to put on that, your EBITDA or whatever. ROI when you're small is easy to keep high because you can be very selective, but your cost of operating can be quite high in those environments. So I think your sweet spot where your cost of technology development, staff, etc., is proportional to what you're doing. I think you want to be 20 and 30 million upwards, and probably 200 or 300 million in a world where it's a $5 billion Sunday market. And that's what, I'm sure you saw, Michael, we're running a competition at the moment, looking for some of these smaller groups and allowing them to come into kind of our umbrella, sit inside our technology, sit inside our risk management and reporting layers, and let them just trade and just price. So White Swan is running a competition at the moment that is looking for those individuals, and the winners were giving a $3 million trading balance on Kalshi, and the runners up $1 million trading balance on Kalshi. So, and I think there's hundreds of people coming up in that area where they've got a bit of friends and family, they've got a bit of tech, and some of them will go broke, and some of them will become significant players in 4 or 5 years' time.
Yeah, that makes sense. So you're going to give them the sort of bankroll and I guess a bit of tech to couple with their pricing.
Yeah, tech, risk management, consulting, overviews, all of those things to allow them to scale instantly is a silly word, but allow them to scale quickly and remove a lot of the cost base out of reaching all of those markets. We've already consumed that cost base. It's no need for other people to write it again, particularly if they're our partners.
Yeah, that makes sense. A couple more questions from the audience. We've got one from Mark, who is asking, if you have any views on prediction markets becoming a legal product within Australia or other legalized markets around the world.
I'm not really the regulatory expert. It's crazy. I kind of see half of Europe saying prediction markets are banned. And I'm thinking, well, how are you really banning them? Because they're already permitted in Malta, Gibraltar, the UK. So, as I think I've said a few times, the scale at which these things are growing, I'm so tied up with technology, pricing, ecosystem, that I'll let the regulators work out what's allowed and not allowed. Exchanges are already in Australia. Betfair's been there, at least 10 years? So I think people will chew at the edges of what's allowed around the world. And you'll have grey markets and you'll have white markets. But I would say broadly, prediction markets will become popular everywhere.
We've just hit the hour mark, and I think we've got through most of the questions there through the audience. So I think we might wrap it there. Bernard, thanks so much for your time. Very appreciative for the masterclass in market making today. And thanks to everyone who tuned in today. We'll share the recording soon and welcome any further inquiries about the topic. Feel free to give us an email, either Bernard or myself. And yeah, that's it. Thanks,
and
Bernard.
Michael, look, thanks very much for having me. It's always good to get on a podcast where you're talking to not just an informed individual, but someone who's coming out of an informed group with the Waterhouse Venture Capital Group and their experience and knowledge and their posts and reports and stuff. So, it's good not to be in an environment where you're getting, interesting and tough questions, but very informed questions from an informed group. So I've had fun. And as you say, anyone who's got questions, write them to you, flick them on to me, hook me up with anyone who wants more information.